The year is 2025, and something about this moment should make you pause. On the surface, everything looks fine. Markets are strong. Technology headlines promise a future powered by artificial intelligence and endless innovation. Politicians talk about resilience, analysts talk about growth. But if you look past the noise, a different story begins to emerge. The echoes are getting louder. The same attitudes, the same confidence, and the same structural weaknesses that existed before the greatest economic collapse in modern history are showing up again, almost line for line. Most people look at rising asset prices and assume that means prosperity. But history teaches us that rising prices can also be a warning, not a reward. When most people hear Great Depression, they think about what came after the crash. They imagine bread lines, abandoned farms, and mass unemployment. What they rarely focus on is what came before it. The collapse of 1929 did not come out of nowhere. It was preceded by years of optimism so intense that it drowned out reason. The Roaring Twenties were not just culturally vibrant, they were financially intoxicating. Stock prices rose year after year. Credit became easy. Risk was reframed as opportunity. The entire nation slowly convinced itself that the old rules no longer applied. That belief, more than any single event, set the stage for disaster. By the late 1920s, the stock market had become a national obsession. Everyone seemed to be involved. Factory workers, office clerks, small business owners, and millionaires all believed they had discovered a reliable path to wealth. Newspapers ran stories celebrating ordinary people who struck it rich overnight. Market participation was treated almost like a civic duty. To question it was to admit you did not understand the modern world. Prosperity felt permanent, and permanence breeds carelessness. One of the most dangerous forces at work was easy credit. People were encouraged to buy stocks on margin, meaning they only had to put down a small fraction of the purchase price. The rest was borrowed. As long as prices kept rising, this seemed like genius. But leverage works both ways. When prices stalled and then fell, margin calls forced people to sell at the worst possible moment. What started as a correction quickly turned into a cascade. Confidence vanished faster than it had formed. At the time, leaders reassured the public. Politicians insisted the economy was fundamentally strong. Central bankers believed they had learned how to manage cycles. Commentators spoke confidently about a new economy driven by technology and efficiency. Some familiar? These reassurances were not malicious. Many truly believed them. But belief does not change reality, and reality eventually asserts itself. Fast forward nearly a century, and the language has changed, but the mindset feels eerily similar. For more than a decade, interest rates hovered near zero. Borrowing was cheap, sometimes practically free. This environment reshaped behavior across the entire economy. Companies borrowed aggressively. Governments ran persistent deficits. Consumers accumulated debt under the assumption that growth and rising asset prices would always make it manageable. Risk became something to manage later, not now. Entire industries emerged that could not exist without easy money. Investors poured capital into companies with no clear path to profitability, convinced that scale and disruption mattered more than earnings. Valuations soared on future promises rather than present results. Anyone who questioned this approach was labeled outdated or pessimistic. The phrase, "this time is different," returned, just as it always does near the peak of a cycle. Wealth inequality adds another layer to this comparison. In the late 1920s, wealth concentration reached levels that alarmed some economists even then. Today, that concentration is even more pronounced. A small percentage of households control a massive share of assets, while a large portion of the population struggles with stagnant wages and rising living costs. This imbalance matters because consumption drives economic activity. When most people have little room to spend, growth becomes fragile, even if asset prices look impressive. In both eras, the middle class played a critical role. In the 1920s, many households used credit to maintain a lifestyle that rising prices had made expensive. Today, households rely on credit cards, student loans, and mortgages that stretch budgets thin. The system functions as long as income grows and confidence remains intact. But confidence is not a resource that can be printed or legislated into existence. Once it breaks, it is difficult to restore. Another similarity lies in how technology is used to justify extreme valuations. In the 1920s, radio was the revolutionary technology of its time. Companies associated with it traded at prices completely disconnected from earnings. Investors convinced themselves that traditional metrics no longer mattered. Today, the language revolves around artificial intelligence, electric vehicles, and digital platforms. The technologies are real and transformative, but the belief that they eliminate risk is not. Innovation does not cancel economic gravity. What makes the current situation potentially more unstable is how interconnected everything has become. In 1929, financial systems were far less integrated. When banks failed, the damage was often local or regional at first. Today, markets are global and instant. Capital moves across borders in seconds. Automated trading systems can amplify fear at speeds no human can control. A shock in one corner of the system can ripple outward almost immediately. Debt levels also change the equation. After the last major financial crisis, aggressive intervention stabilized markets, but it came at a cost. Debt did not disappear, it grew. Governments took on massive obligations. Central banks expanded their balance sheets. Corporations refinanced repeatedly at low rates. These actions bought time, but they also increased dependence on favorable conditions. When rates rise or growth slows, the strain becomes visible. Signs of stress already exist, even if they are not always front-page news. Certain sectors struggle quietly. Some assets are valued based more on hope than fundamentals. Institutions manage losses carefully to avoid triggering panic. This does not mean collapse is inevitable tomorrow. It means the system is less resilient than it appears during calm periods. Social trust is another critical difference. In the 1920s, despite inequality and speculation, trust in institutions remained relatively strong. Today, that trust is weaker. Many people question government competence, media narratives, and corporate motives. When economic stress arrives in an environment of low trust, reactions can be more volatile. Fear spreads faster when people do not believe the reassurances they hear. History shows that market peaks are not marked by fear, but by confidence. Warnings are dismissed. Risks are reframed as opportunities. Experts explain why old models no longer apply. The public borrows against assets they believe can only rise. These patterns are not signs of intelligence or progress. They are signs of human psychology repeating itself. The crash of 1929 did not unfold in a single dramatic moment. It was a process. Small declines were ignored. Temporary recoveries restored confidence. Only when losses became impossible to deny did panic take hold. By then, it was too late for many. Fortunes built over years vanished quickly. Institutions once considered unbreakable failed. The belief that the system was self-correcting proved dangerously incomplete. Today's system is larger, faster, and more complex. That complexity can create resilience, but it can also hide risk. When problems are spread across many interconnected parts, they are harder to see clearly and harder to contain. The same tools that create efficiency in good times can accelerate damage in bad times. None of this means history will repeat exactly. It never does. The next crisis, whenever it comes, will have its own causes and consequences. But the patterns leading up to crises are remarkably consistent because they are rooted in behavior. Overconfidence, leverage, and the belief that growth is guaranteed appear again and again. Understanding these patterns is not about predicting dates or spreading fear. It is about perspective. When markets rise steadily, caution feels unnecessary. When technology advances rapidly, it feels logical to assume disruption will solve every problem. But history reminds us that progress and risk coexist. Ignoring one does not eliminate it. The echoes between 1929 and today are not accidents. They are reminders written into the structure of financial systems and the psychology of investors. The same confidence that once convinced a nation that prosperity was permanent has returned, expressed in modern language and new technologies. Whether the adjustment ahead is mild or severe is uncertain. What is certain is that cycles driven by human behavior do not disappear simply because we want them to. History does not punish optimism, it punishes blindness. Those who study the past gain context. They learn that markets can rise for years and still be vulnerable. They learn that innovation does not erase risk. They learn that debt amplifies both gains and losses. The people who recognize these lessons early have options. The people who ignore them are often forced to learn the hard way. The echoes are getting louder. They are not warnings of doom but signals of imbalance. Listening to them does not require panic. It requires awareness. The past is not a script, but it is a guide. And in moments like this, history has more to teach than the headlines ever will.